Good day, Siegfried here from Cloud-Based Services Accountants. And again, today I would like to explain to you the different taxes. And there's a lot of confusion about what is your tax that you're paying. And then sometimes there's tax that you collect on behalf of IAD. That's not your tax, but somebody else is paying it and you're just collecting it. And specifically, I'm talking about PAYE. When you deduct PAYE from your staff, you're actually collecting the PAYE from your staff's wages and then pay it over to IAD. So PAYE is not your tax. That's your staff members' tax that they are paying. It's not you that's paying PAYE. Another tax that you collect on behalf of IAD is your GST. GST is not your tax that you pay. Your client, you charge GST. You add GST on top of your price that you for your products or whatever your services. So that's not a tax that you pay. So the first piece of advice is don't use your GST money that you collect on behalf of IAD or the PAYE that you've deducted from your staff salaries. Don't use that as part of your cash flow. That's very dangerous. I suggest, from my side, the easiest way to treat that is to shift those funds out of your normal operational bank account and shift it to a savings account, and then make sure that the amounts are available at the predefined times when you need to pay them, that it's available to pay them, and never touch that as part of your general cash flow. So to explain that, let's quickly go to Xero. I'm going to share my screen with you, and there we go. We're on the demo company of Xero. And firstly, let's talk about your PAYE. So let's say you've got a payroll. At any stage, if you want to know what's my tax payable or my PAYE payable, not your tax, but your PAYE payable, you can go into your payroll and go to taxes and filings. So every time you file, you're on a pay run and you post the pay run to be filed with IAD, you will see there's a total tax payable. So this was for April, month of April, and you can see that the total tax payable by the 20th of May, so it even tells you when it's payable, is $330. So you can frequently come to this report and make sure that you've set those funds, you've removed it from your operational account, your bank account, shift it in a savings account, and make sure that it's available to be paid by the due date. Similar scenario, GST. If we go to accounting, you go to GST return. Obviously, we're in the middle of a period because the GST period is usually from, in this case, from April to May, bi-monthly periods. But you can go and preview the period so far. So that will tell you either you've got a claim or you've got GST payable. So if you look here, you'll see that at this stage, there must be a provision of $3,291 that you've set aside for your GST that you've collected. So this is not your money. This is money that you've collected on behalf of IAD or the government. So if we go and look at how the GST is calculated, it's basically your total sales and income and the GST collected. You can see GST collected on that sales and income, 4,100. But then you receive credit for the GST that you've paid when you purchased, let's say, items for your business. And you can see you get credit on those purchases of $808. So the balance is actually the GST that's payable to IAD. So IRD allows you to deduct any GST that you've paid, deducted from the GST that you have collected, and that's the balance owing. So I would suggest, it depends on how many transactions go through your bank account or through Xero. But even if you have to do it on a weekly basis, come to your GST return in Xero, and as mentioned, preview the period so far. So GST and PAYE is not your money. That's money that you have collected on behalf of IRD, and somebody else is paying that. You're just holding that money in trust. And that's why IRD is very strict about that. If you collect money on their behalf, and then you start using that money as part of your cash flow. And that's why you get penalties and interest and so on if you don't pay that. Okay, so what is considered as your tax that you pay? So you pay tax on your income. So that's the only tax that you pay, is you pay tax on your income. So the similar story throughout the year, at any stage, you can do a quick profit and loss report. So we're going to profit and loss, and we go to year to date. Let's go year to date. So from the start of this financial year, 1st of April to today, we update it. At this stage, obviously things can change during the course of the year. You can have perhaps massive expenses that will reduce that net profit amount. But the bottom line is you will eventually pay tax on this. So if you want to make provision, that's your net income. So if you want to make provision for personal income tax, it will be made on this amount. So because this amount, and I'm going to explain the technical reasons why we do that, but this amount will be shared between the shareholders of the company, and they will pay tax in their personal capacities. So let's say, for instance, on that $29,000, there's IRD calculators where you can calculate at any stage. It's easy to calculate what's my tax payable on, let's say, $29,000, and you can calculate that, and you will see the end result, or let's say $3,000 or $4,000. Make sure then that you shift that apart as well, to make provision for your year-end tax. But this is not so crucial to shift that out of your operational account. But GST and PAYE, absolutely important to shift that out of your operational account. So just to explain another concept, and say after year-end, you have received now a shareholder salary. It's actually the profit, or your portion of the profit has been allocated to you. There will be a tax return. We'll prepare a tax return for you. And this is a typical tax return. So now we come to you at the end of the year, and we tell you, okay, your shareholder salary, that was $72,000 plus a little bit of interest that you received from, let's say, from the bank. So your tax on that amount, your tax is $14,758. So that's the tax on that total income, 72,238. Okay, you get credit for some withholding tax that's been deducted from your income that you receive, mostly from the interest. And so your residual tax to pay is $14,733. Great. So that amount is usually payable. They call it the terminal tax. So that is payable only by the following year, the next year. You can see this is now for the 31st of March 2022. So this amount is only payable, that's now for your 2022 tax year. That amount's only payable by the 7th of April 2023. So it's exactly, or more than a year in the future that is payable. But that's for your 2022 year. So that's the 14,000. Now, provisional tax is not a double tax. It's to make provision for your tax payable throughout the year. So, and there's a standard method of calculation, which is you take your 2022 year-end tax, or your terminal tax, and you add 5% on top of that. So you'll get then 15,469 on that amount. So that's that amount plus 5%. And that gets divided into 3 equal installments. The first one payable on the 28th of August, let's say in this case 2022, second installment on the 15th of January, and the third installment of the on the 7th of May. And so if you add these two together, you see there's an amount, total tax liability. One is for the 2022 year, and the other one is provisional tax for the 2023 year of $30,000. So a lot of clients immediately say, wow, I'm paying $30,000 on 72, that's almost 50% tax payable. No, that's not right. That's not true. Your tax payable on the 72 is only $14,000. And that is to make provision for the following year, the next year's tax. So you're not paying double. If you earn a PAYE salary from an employer, with your first paycheck, they will start deducting tax from you. As a business owner, you've got no special benefits. You're still required to pay tax. And this is the way that you can make provision throughout the year to start paying tax. And it's basically an estimate that's used, and that's a standard method, where they say, we estimate, that's IID, we estimate that you will receive in the following year similar income plus 5%. And that's why that calculation was done here. So, and again, you will see the different dates. So don't confuse this as to be a double tax. It's basically, if this first one is just your terminal tax, and then the balance is the provisional tax for that next financial year. I trust that this clarifies this matter, and if you've got any questions, please don't hesitate to contact me. Cheers.